Picture this. It's a payday in mid-2026. You check your bank balance expecting that tax cut everyone's been talking about, and you can barely tell the difference. That's not your imagination. For most workers, the rate cut itself is worth only about $268 a year, roughly $5 a week. But stick with me, because by the end of this, I'll show you exactly how to turn that small cut into more than $1,000 a year using two things almost nobody is talking about. Let me show you where that number actually comes from, because once you see it, you'll never fall for the headline again. From the 1st of July 2026, the tax rate on income between $18,201 and $45,000 drops from 16 cents to 15 cents in the dollar. That's just 1 cent less on one slice of your income. If you earn $45,000 or more, that cut is capped at $268 a year, and if you didn't know that, that's completely normal. The way it's reported almost guarantees you'd assume it was bigger. Here's why this matters to you specifically. If you overestimate the 2026 cut, you tend to underplan for the things that quietly eat into it. The Medicare levy, your help repayments, and bracket creep as your wages rise. And on the flip side, if you ignore the new instant deduction and the new offset, you can forgo around $455 a year in benefit. Over 20 years, that's roughly $9,100 in nominal terms, and far more if you'd invested it. So a few minutes here is genuinely worth real money to you. And here's the part most people miss. It's coming up next. Now, you've probably also seen the bigger number, $2,816 a year. That one's real too, but read the fine print with me. That figure is the maximum saving for an average earner from 5 separate measures combined, compared all the way back to the 2023-24 tax system. Most of that already landed in your payback in 2024 with the Stage 3 changes. The part that actually changes for you in 2026 is small, so when you hear a politician quote thousands, they're usually adding up years of changes you've already received. Move 1 is to work out your real number instead of trusting the headline. Log into MyGov, open ATO online services, and download your most recent notice of assessment. This shows your taxable income and the total tax you actually paid. That's your starting point, because you can't measure your saving until you know exactly what you're paying now. And honestly, almost everyone skips this step and just trusts the news instead. You're already ahead by doing it. Now let's run your number 3 ways so you can see yourself in it. If you're on the lower end, say $30,000, only the slice above $18,200 gets the cut, so you're looking at about $118 a year. If you're somewhere in the middle, above $45,000, you land on about $268, roughly $5.15 a week. And if you earn more than that, you don't get more. The saving is capped at the same $268. Take your taxable income, apply the new 15-cent rate to that lower band, subtract from your 2025 to 26 tax, and you'll see it for yourself. And here's where it gets a little more interesting. There's a second cut coming. From the 1st of July 2027, that same low band drops again from 15 cents to 14 cents in the dollar. If you earn above $45,000, that adds another $268 a year. So by 2027 to 28, the two rate cuts together are worth about $536 a year compared with now, roughly $10.30 a week. Still automatic, still modest, but now you know the real figure to plan around. Move 2 is where your real upside hides. From the 1st of July 2026, there's a new instant deduction of up to $1,000 WAPAS, and you can claim it without itemizing and without keeping receipts. But I want to be upfront with you about the catch most people miss. It's a deduction, not a cash refund. It reduces your taxable income by $1,000, so your actual benefit is your marginal tax rate times that $1,000. At a 30% rate, that's $300 in your pocket. At 15%, it's $150. Treasury estimates an average benefit of $205 across 6.2 million workers. To make the most of it, plan ahead. In ATO Online, open your last return and list your usual work-related costs. Think home office expenses, tools, professional subscriptions, and professional development. Check they're genuinely work-related, and that across the year they'll reach or exceed $1,000 from the 1st of July 2026. Keep basic evidence even though receipts aren't required, and when you lodge, claim the full $1,000 instead of underclaiming out of habit. Done right, that's around $300 a year you'd otherwise leave behind. And the next move is the one most people never even hear about. Move 3 is the one you're most likely to miss. From 2027 to 28, there's a new permanent working Australians tax offset worth $250 a year for more than 13 million workers. The key word is working. It applies to your employment or sole trader income, lifting the effective tax-free threshold for work income by nearly $1,800, up to $19,985 or as high as $24,985, where the low income tax offset also applies. But here's the honest part. If your income is investment only, you may not get the full amount, even though you heard the words $250 tax cut. To actually receive it, do a quick check. In ATO Online, make sure your main income is reported as salary, wages, or sole trader business income and not misclassified. Then from 2027 to 28, when you lodge, confirm the $250 offset shows up in your notice of assessment. If it isn't there, review your income labels or ask the ATO or your tax agent why. And if you're part-time or casual, make sure your annual work income is high enough to qualify for the full offset. It's an easy thing to overlook. Now let's put it all together with a real example. Say you're like Sarah, a marketing manager in Sydney on $85,000, doing nothing extra. By 2027 and 28, you'd get $536 from the 2 rate cuts. But add the full instant deduction at your 30% rate. That's about $300. Add the $250 offset. Suddenly you're on about $1,086 a year instead of the $268 you'd have had focusing only on the headline. That extra $550 a year invested over 31 years at a real 4% could grow to around $32,000. Before we recap, let me help you dodge the 3 traps that catch most people. First, don't assume the 2026 cut is worth thousands. The rate cut itself is about $268 a year, and the bigger numbers just add up years of past changes. Second, don't treat the instant deduction as a $1,000 refund. It's your marginal rate times 1,000, so $300 at 30%. Third, don't assume the $250 offset lands automatically for you. It needs work-derived income, so check yours is classified correctly. Let's run it back quickly. Step 1. Log into MyGov. Download your notice of assessment and work out your real saving, which is about $268 if you earn over $45,000. Step 2. Plan your work expenses and claim the full $1,000 instant deduction from 2026. Step 3. Make sure your income is work classified so the $250 offset reaches you from 21 to 27 to 28. The rate cut on its own is small, but used together, these tools can lift you to over $1,000 a year. If you've made it this far, you now know something most workers don't. That the 2026 cut is real, but the smart money is in the tools around it. Your next step is simple. Log into MyGov today and download your notice of assessment, so you've got your real starting number ready if you want to go deeper. Next, we're breaking down how to legally maximize your work-related deductions before the new rules kick in. Remember, this is general financial information only and not tax advice. Always check with a registered tax agent or the ATO before you lodge. I'm Sophie. I'll see you there.